The corporate rules are essentially about one thing. They constitute Treasury and SARS recognition then that one should not always be pouring sand into the gears of commerce, and that indeed sometimes one should grease the wheels of commerce. Tax should not stand in the way of sensible and productive business combinations. That is essentially what the corporate rules are about. They're also about a great deal more than that. They offer very comprehensive tax relief on a wide front. They offer relief in the form of a deferral, not only from capital gains tax, but from associated tax charges in the course of the incorporation of businesses, in the course of asset transfers between companies. Okay? You should appreciate, however, that the corporate rules are something like a one-way valve. Assets can flow into companies. Assets can flow between companies. But with a rare exception, you will not get relief when something flows out of a company to a trust or to natural person shareholders. This is intercompany, largely intercompany tax relief. Okay? Now, by way of a further general introduction, I think I might fairly predict that you are going to enjoy this morning. Enjoy this morning in part because I think you will be seeing a somewhat different perspective on the corporate rules, and for that matter, tax in general, as opposed to those perspectives which ordinarily color a presentation. The different perspective comes from the fact that I am a general commercial lawyer. Tax is part of my skill set. Yeah? Tax is what I use to attract what I best love doing. And what I best love doing is the undertaking of complex commercial drafting. My principal interest lies in the implementation phase of corporate transactions. It lies in the drafting of the associated contracts. And for that reason, as we proceed through the morning, you will find that you are presented with much more detail than you might be accustomed to in relation to the nitty-gritty of the drafting of related agreements. And I hope that you will share my fascination with that detail. As the saying goes, variously, God is in the details, or if you have a somewhat different perspective, the devil is in the details. Okay. Now, enough, I think, by way of introduction. What I'm going to do in the first session this morning is to present you with a broad overview, a bird's eye view, if you like, of the corporate rules. We're going to skim lightly over the corporate rules to begin with. The rest of the morning we'll be delving into detail. We will examine the corporate rules one by one. We are going to linger, especially for much of the morning, over section 42, asset for share transactions, because it is section 42 that opens up a rich vein of possibilities. Let's get underway. The first of the so-called corporate rules is section 42. It governs asset for share transactions. As the term asset for share transaction implies, what section 42 is about is the transfer of assets to a company, principally against an issue of shares, so-called equity shares, for which read ordinary shares, shares which participate in dividends without limitation, as opposed to, for example, a 6% fixed preference share. If you're the holder of a 6% preference share, what you get is a 6% fixed return on the money you subscribed against the issue of the shares. That is not an equity share. It will not be a qualifying share for the purposes of an asset for share transaction. One aspect of the asset for share transactions, which has proved to be particularly useful, is that it may be used also to effect a share for share exchange. The assets that can be transferred to a company against an issue of shares include shares themselves. So you can transfer shares in an existing company to another company against an issue of shares by the recipient company. And if you transfer all of the shares to a recipient company against an issue of shares by that company, what you have is, presto, an interposed holding company. We'll look at that kind of maneuver and the utility of that maneuver in very substantial detail later on this morning. Section 43 used to cover a wider ground by way of substitutive share transactions. Since the 1st of April, the ambit of Section 43 has been very substantially narrowed. It deals now only with the disposal of so-called linked units in exchange for ordinary shares associated with the introduction of REITs. If you had a linked unit, that is a share to which a debenture has been linked, and you transfer your linked units against an issue of shares by a REIT, you get rollover relief for doing so. Rollover relief signifying that the relinquishment or abandonment of your linked units will be taken to have been effected at base costs. And the base costs of your former linked units will be carried over to those shares which you acquire in exchange. Now, Section 43 also used to cover things like the conversion of a CC to a company, or a co-op to a company, or share splits and share consolidations. All of that has now been parked, and not entirely satisfactorily so, in paragraph 12.2L of the 8th schedule. We will look at paragraph 12.2L towards the end of this morning. Section 45 covers intra-group transactions. As the term intra-group transaction implies, what we are concerned with here are the transfer of assets between companies in the same group. Section 46 covers unbundling transactions. Now, that term is not necessarily self-explanatory, so perhaps I should dwell on it just a little. You have an unbundling transaction where a company which has shares in a subsidiary affects a distribution of those shares. Yeah? Unless the subsidiary company is destined to be listed within 12 months, all you are permitted to do by way of an unbundling transaction is to transfer the shares in the subsidiary upstream within the group, perhaps to the ultimate holding company in that group. If the subsidiary in question is destined to be listed within 12 months, you can transfer the shares out of the group to the ultimate individual shareholders or spread of shareholders in the holding company. Section 47, as the name implies, deals with distributions effected in the course of or in anticipation of the liquidation of a company. Section 47 will extend rollover relief only if the company in question is a subsidiary company and the distribution is being effected in favor of a holding or intermediate holding company within the same group. The notion of a group for tax purposes turns around a common holding company with a minimum 70% share linkage, in every step in a chain of subsidiaries. Okay? Now, it is often the case that a picture conveys a concept much more tellingly than a flood of words. So I'm going to give you a diagrammatic representation of each of the corporate rule maneuvers. Section 42 allows again for the transfer of assets by any person to a company against an issue of shares, or in some cases an issue of shares complemented by an assumption of liabilities. Where Section 42 says that the permitted transfer is a person, you have to take on board the tax definition of a person includes a trust. So this is a maneuver that may also be engaged in by a trust. A trust may transfer assets to a company against an issue of shares and perhaps also an assumption of liabilities. The notion of a person also, of course, embraces a company, which has a legal personality. It is also then open to a company to transfer assets to yet another company against an issue of shares and or an assumption of liabilities. I shouldn't say and or, it's just or. Okay? The issue of shares is a vital component of an asset for share transactions. You may combine it with an assumption of liabilities, but first you have to have an issue of shares. Okay? I said that it is possible to effect a share-for-share exchange utilizing Section 42. The diagram illustrates to you how this might be done. Our starting point is that an individual, X, holds 100% of the shares on issue in a company. Now, X is all too impersonal. Let's call him Xerxes. What Xerxes does is enters into a share sale agreement under which Xerxes as seller sells his entire shareholding in Company A to Company B as purchaser. In consideration for the transfer of Xerxes' shares in Company A, Company B issues shares in itself to Xerxes. And the position on completion, as depicted for you on the diagram, is then that Xerxes comes to hold all the shares on issue in an interposed Company B, and Company A is positioned as a wholly owned subsidiary of Company A. Now that is the starting point to a series of transactions which have a particular utility in the context of black economic empowerment ownership transactions. And we will explore that in considerable detail later this morning. But hold this picture in your mind, because much turns on it. I've given you also a diagrammatic exposition of an amalgamation transaction pursuant to Section 44. An amalgamation transaction is, in essence, a transaction pursuant to which a purchaser company, called the resultant company, in section 44, purchases the assets of another company, the seller company, or the amalgamated company, as it is termed in section 44. Pursuant to that agreement of purchase and sale, the assets of the amalgamated company, all of them other than those it retains in order to settle debts, are transferred to the resultant or purchaser company. In exchange for the transfer of the assets, the purchaser or resultant company may do two things. It may assume certain permitted liabilities of the seller or amalgamated company. And in addition, and as to the balance of the purchase price, it may issue shares in itself, that is, shares in the resultant company, to the amalgamated company. What this achieves is a merger of the assets of the two companies. The amalgamated company is stripped of its assets are merged with the assets of the resultant company. The final phase in an amalgamation transaction is constituted by the amalgamated company taking those shares which it had recently acquired in the resultant company and distributing those shares in specie, as they are, to the shareholders in the amalgamated company. So your shareholders in the amalgamated company, shareholders X, Y, and Z on your diagram, will come to hold shares in the resultant company. The maneuver culminates in the winding up of the amalgamated company, and it then goes off the map. Now, once the amalgamated company is off the map, what you have is just one company, the resultant company, the continuing company, and you can see on the diagram that shareholders A, B, and C, the old amalgamated company shareholders, have now joined the ranks of the shareholders in the resultant company. Just a cautionary word here. The Companies Act contains its own definition of an amalgamation or merger. That definition is broader and more flexible than the narrower, more restrictive definition under the Income Tax Act. If you are going to implement an amalgamation transaction and you want to secure for your clients rollover relief under Section 44, you must follow the more restrictive procedure under Section 44 rather than taking those shortcuts which are presented to you under the Companies Act. The shortcut there comes down to this. Under the Companies Act, instead of the resultant company issuing shares to the amalgamated company, the resultant company may effect a direct issue of shares to the shareholders in the amalgamated company. But take that shortcut and you will not have complied with all of the elements of the definition of an amalgamation transaction under Section 44. Under Section 44, the resultant company must issue its shares to the amalgamated company, which must then effect a distribution of those shares to its shareholders. Okay? Be careful there. I will repeat that caveat, that cautionary note at a later stage when we look in detail at amalgamation transactions.